Let's go to this line in your notes. Of course, we have the Fed meeting kicking off today, that rate decision coming tomorrow. You write that we cannot address housing or inflation without addressing the causes. The Fed's policies increased inflation, and now we must work to bring those costs down. What does that process look like? Costs coming down, and how does that translate into this housing market, which just seems to be frozen?
Well, let's start with the expectations for tomorrow's Fed decision. Most people aren't expecting there to be an increase in interest rates. The Fed's, if you look at today's inflation, it's about 3.2%, still well down from the 9% peaks in 2022, but still 120 basis points higher than the 2% target for the Fed. And so if you add to the fact that today, the Bank of Japan, after 17 years, finally increased their interest rate and is the last major central bank to come off of negative interest rates. There's really very few drivers that would predict a Fed increase tomorrow. But I think if you look beyond that or under that, one of the major drivers of continued inflation and what's made it so difficult is our housing prices. If you look, even though broader inflation is 3.2%, housing prices increased 5.7% in the same period of time, and rent increased about 6%. And so if you look at gasoline and housing together, they represent roughly 60% of all of the nation's inflation at this point in time. And so you can't really begin to address the larger inflation problem without really focusing on what's going on in the housing market and today.
Well, let's talk about what's going on in the housing market, because it feels like there's at least two factors that are really keeping some of those figures that you mentioned high. You have, of course, high interest rates controlled by the Fed, but you also, it seems to have this structural undersupply of houses available to be sold. So, I mean, even if rates come down, how much pent-up demand is there for what is a relatively limited supply of houses?
Yeah, I mean, that's the problem. Thankfully, housing starts and housing finishes were up last month, but in general, there's still a chronic undersupply of houses in the United States. That is why today, roughly 30% of Americans pay more than 50%, roughly 50% of Americans pay more than 30% of their income in housing and housing costs, which is by definition housing burden. And that's not a recent thing. That's been true for some 60 years. In fact, if you look at the last decade or so, inflation has grown by 31% over that 10-year period, but housing costs are up 61%, so twice as high. So there's just been a perennial long-term demand. I think the challenge is to find ways in the market to create more housing and to encourage supply.
Well, let's talk about where the Steinbridge Group comes in, because you're an impact investing firm. Where have you been deploying capital, and what has the results of those investments looked like?
Sure. Yeah, today we have about $500 million of active developments around the country, growing that to roughly $1.3 billion over the next 12 to 24 months. One of the unique ways in which we develop is to identify underutilized assets held by nonprofits and to catalyze those into productive uses. That provides homes for folks who need them, and it also activates land that's underutilized and owned by nonprofits. One of the subsectors that we focus on is single-family housing. So when you think about the overall housing market, +50 to 60% of all rental units are actually single-family units, not multifamily units. And roughly 60+% of renters are in single-family homes, not multifamily homes. So you really can't address the affordability problem without also addressing single-family homes. So one of the major things that we do is supply single-family homes, and the market is beginning to come around to that idea. If you look at the performance of REITs in the residential sector, single-family REITs well outperformed multifamily last year. The total return on multifamily REITs was around 5.8%. The total return on single-family REITs was about 21%, so almost 4 times. And today, the single-family REITs represent roughly 30% of multifamily REIT market value. So for the first time, the market is beginning to understand that you can't really address the housing gap and the affordability gap without putting significant investment into single-family homes, and that's one of our primary strategies.
Okay, so single-family homes, clearly an area of focus for you. Talk to me about impact investing in real estate, because I talk to a lot of just regular real estate investors without the impact part. Where did you land on that specific strategy? Why impact investing?
Yeah, I think there are two areas of impact for us. One is how we identify the land to develop. and that is by identifying community partners, partnering with them to catalyze their underutilized assets to economically productive uses. The second is by focusing on working families, focusing on people in the middle who are most housing burdened. If you look in about the 1980s, it took roughly 2 to 4 years to save to buy a home. And today the statistics suggest that it'll take 9 to 11 years for a family to save for a home. And so we are targeting those families. So we're looking both at the input, looking at how we identify and source homes by partnering with landholders, community landholders, and we are looking at the impact of targeting middle class and working families. And so we think that's the best way to add impact to our investment.
And we only have about a minute left, but I'm curious to know actively you're in single family homes, but talk to us about geography.
Sure.
Where in the country are you most active at this point in deploying capital?
Sure. We recently announced a $100 million commitment to historically black colleges and universities, and that is consistent with our impact theme, idea, and strategy. One of the interesting things, it's also a very good real estate strategy because there are 100 plus historically black colleges and universities, but 90% of them are actually in the southern path of growth, in the states that have the fastest growing economies, the fastest growing jobs, and where the remigration is occurring, like North Carolina, Texas, Virginia, and Maryland. And so we are looking at partnering with these institutions, catalyzing their underutilized land that is well positioned into economically productive uses, and that is consistent with where the country is moving geographically.